Everyone, welcome back to Smart Investing. Today's stocks are for the banking services sector stocks. I have three stocks to go over with you guys. We're going to look at some fundamentals, technicals, and some quants. Today is June 15th, 2023, Thursday. It is 2:01 p.m. Markets are open and they close in 2 hours, so you will see real-time data when it comes to price action. First stock up that I have is ticker symbol ONB, Old National Bank Corp. So we have this stock at a market cap of $4 billion. Price right now is at $13.99. It has gained 1%. So we have the earnings at 2, dividend is at 56 cents per year. Definitely very, very valued, very undervalued, but that's if it's worth it based on the company's numbers. Excuse me. So we have the 5-year chart. Breaking even or breaking down the middle looks like about $15 and I don't know, 30 cents or 25 cents, around that range. For the year, it has been on a downtrend for 3 months. Still looking to break even. The past month has gained actually 15%. So moving on to the next data point, we have here analyst ratings. I don't really look at them, but there they are anyway. It's rated at 42. Hold up. So it's rated basically at 50% of a buy. Quant rating, we have here the highest rating is value. I'd agree with that. And the lowest number is momentum. I can agree with that. Around that range. So as for quality, I doubt it. For growth, I doubt it. Income, I doubt it. I think the only way a bank can grow is if they sell the bank and somebody else acquires it. The shares go up temporarily. You're in a momentum stock. I don't know. Give it a week or two, and that's pretty much it. While they finalize the details, you cash in, cash out. Easy money, easy transaction. Hopefully you didn't get too greedy and made a nice little chunk of change for that week. So moving on to the fundamentals, diving a little bit deeper. Q2, it's not giving me anything for Q2, so I want to skip all this. I want to see the debt, 89%. Let's look at their margins. Kind of went down. So that was 1%. That varies. ROE, net income has gone up. Revenue has gone up. Operating income, it's not giving me anything. 2022, pretty much doubled. Pretty much doubled from 2021 going into 2022. That's pretty weird. Unless they acquired so many companies, contracts, or customers throughout that time in 2022. Or they might have saved some cash on the sidelines to put money to work when the time was right. So who knows? But for a $4 billion market cap company, they seem to be doing okay. Now, the cash flow for this is, need another 800. Oh, they have negative cash flow, but they're close to breaking even. So it looks like they do spend the rest of that money from the net income to balance that out. So I was looking forward to seeing a stock doing okay, but the cash flow is awful, and I don't even want to look at the dividend history, but again, I'm sure they're not raising dividends. All these dividends are 14 cents for the last, I don't know, last 4 years almost. So yeah, this is not an income stock, but again, to each their own. So for this stock, I'm going to say no and move on to the next one. Next one up, HAFC. Market cap is at 500 million. The share price is at $16.35. Looking at this first page here, it's got a lot of work to do. That PE ratio, PE ratio is awful, and a dividend only of $1. Awful, awful, awful. So last month it has raised its share price, which is good, but for the 5 year it is still pretty much breaking even. And it will be really, really hard for it to gain new highs. Now, this was for the past year. High was in the mid-20s. So moving on from that, the technicals do not support it, not as of yet. And we have here the analysis of hold rating 83%. Highest rating for the quant is the value. Pretty typical for a bank. Since it's cheaper, more affordable, that gives them more value. The rating is at 7.87, close to 7.9. Rounded off to an 8. I don't know about that, but we'll look at some numbers. Looking at the financial estimates, we have here Q1, they met expectations. In Q2, we're going to see what happens pretty soon. They lowered the guidance from last quarter, and let's see if they'll meet expectations or go below them. Got some annual indicators here. Return on assets plus the return on equity. Earnings have stayed the same from last year and 2021. Margins are pretty high. Debt is at 91%, staying steady. Now we have here the balance sheet and then the cash flow. Cash flow is, wow, at negative. Negative. Not good at all. Not good at all. I'll show off the dividends and then we'll move on to the next one. So they cut in 2020 and they start to raise the dividend slowly but surely ever since late 2020. Now we're back to 25 cents where they left off previously. Now with that said, again, this stock has negative cash flow, so that's actually pretty bad. It's not suitable. So we have the last one, which is HBAN, ticker symbol HBAN. We have here the chart of a 5 year breaking flat. Would be around 1160, give or take. Still has long ways to go up again and beat new highs for it to be decent. Now, looking at the first page again, 62-cent dividend. I mean, earnings are pretty weak, even for a $15 billion market cap company. Really, really awful. Analysis says 50% hold, and some people on Wall Street are with it, and some are against it. Majority of buy ratings, it's 35%. The negative sentiment is at 15%, not to buy. So moving on to the quant rating. Highest quant rating is growth at 7.88%. I'm not seeing that unless I see some cash flow positivity. We have here the deep diving into the financials for the fundamentals, we have here Q2 estimates lower than the Q1, estimating about, I don't know, 35 cents. Some key indicators that we have to go over, ROA, ROE, about the same, not bad, not bad. And what was that compared to the other years? So 2020 and 2021, they weren't even above 20%, barely around 20%. And then 2018, 19, even now, they're having margins increase again. So not bad. But again, the cash flow seems to be the main factor here. We're going to jump right into that right now. Cash flow for operating is about $4 billion. We have $11.6 billion in investing, so that only leaves about $7 billion. So they are cash flow positive from financing. So they have a little bit over $1 billion in cash flow, which is really, really good. Let me look at the analysis again. So they said the highest was growth. So these people have cash on the sidelines, but they're not doing much with it. Unless they're in discussions or whatever. Somebody needs to pay off somebody. So yeah, there you have it. Positive cash flow, but Wall Street has some negative sentiment. And again, there are better stocks than this. With their earnings have dropping so much, I'm surprised earnings is that low. But again, tricky stock, but don't even go for it. It's not even worth it. So thank you guys for watching. That's all I have for you guys. I have one more video for tonight. That'll be done later in a few hours. I'm going to take a break. And tomorrow's another day. So I really want to complete this banking services sector. So thank you guys for watching. I'll see you guys soon. Take care. And again, any questions, comments, requests, I'm more than willing to take. See you guys in the next one.